this class, we will focus on mandatory documents, and specifically, we will investigate the cash flow statement. This statement records cash in and cash out that have occurred during the financial year, with the final purpose to show the net cash at the end of the year. So as you can imagine from the title of the reports, the logic through which all of the cash in and cash out are registered is a cash logic, different with respect to the actual one. These flows of cash in and cash out, are recognized by distinguishing them into three main categories. So if we have our cash flow statement, we can identify the first category in which cash in and cash out are registered, which is represented by operating activities. If we have the operating activities, we can identify the cash in because of the selling of the products, or the cash out because of the purchases of components. So basically we can find all of the cash that enters and goes out because of the operating activities of production. Then we can find the cash in and cash out that is related to the investing activities. If we have investing activities, we have the cash that enters and goes out because of the disposal of assets. So for example, the acquisition of a new equipment, or for example, the disposal of an equipment, a building, or something else. And finally, we have a third category of registration of the cash, which is represented by the financial activities. In the financial activities, again, we register cash in and cash out, but considering all of the cash that changes the equity structure of the company. For example, the requirements of a new bank debt, or for example, the sharing of the distribution of the dividend. In terms of cash flow statement, it can be defined by adopting two different approaches. So the International Accounting Standard gives the company the possibility of defining the cash flow statement by using a direct method or an indirect one. If the direct method is adopted, basically by looking at the three different areas of activities, we can identify the cash in and cash out with respect to the operating activities, investing activities, and financing activities. So if we start, for example, from the operating activity, we can identify the cash in because of receipts from customer, and then the cash out because of the payment of suppliers, employees, or other operating expenses. And then we need to deduct again the cash outflows because of the payment of interest and the taxes. So this is the changes of the cash that enter the operating cash flow. Then we can identify the cash related to the investing activity, so the acquisition of the assets plus the cash in because of the disposal of the assets. And finally, we have the financing activities, in which we can find the cash outflows because of the dividends and the repayment of debts, and the cash in because of the requirements for some debts. If instead an indirect method is adopted, the starting point is an accrual measure. So the starting point of the indirect method is the profit before interest and income taxes, which is recognized within the income statement. So basically we have an accrual value that should be adjusted in order to arrive to a cash value. So if we start from this profit before interest and income taxes, it is necessary to add again all of those costs that do not represent a cash outflows, and these costs are the depreciation and the amortization. We add them because they have been previously deducted in order to calculate the profit. Remember that we are talking about costs which do not give rise to a cash outflows. Then we need to adjust this profit by adding what is defined as operating working capital. The operating working capital accounts for the variation in receivables, inventories, and trade payables, because again, we have a difference between the accrual logic and the cash logic. So let's think, for example, of receivables. If we have at the end of the period the amount of receivables which is higher with respect to the amount of receivables that we have at the beginning of the period, this means that the amount of the cash for the company is lower, and the reason why is because we have receivables rather than having the cash inflows because of the selling of the products. The same happens with the inventories. If the inventories at the end of the period are higher with respect to the inventories at the beginning of the period, we have the impact on the cash, which is negative, because this means that the company purchases inventories, so we have a cash outflows. It is the opposite instead if we have the trade payables, because if we have that the trade payables are higher with respect to what we have at the beginning of the year, the impact on the cash is positive, and the reason why is because we have the debt, in this case the trade payables, rather than having the cash outflows. Given this adjustment, so once we had the depreciation and the amortization and the variation of the operating working capital, the remaining structure is exactly the same of the direct method. So again, we deduct the interest paid and the income taxes. And now, from this moment on, we have this net cash from the operating activity, which is the only difference with respect to the direct method. So then we have the cash from the investing activities and the cash from the financing activities, which are recognized and recorded by using exactly the same approach of the direct method. In the end, we can identify the net cash of the period given again as the difference between cash in and cash out.